All right, now let's stop the sound and make sure that it's recording sound. Okay, now
Everybody, can you quiet down for a minute?
it's there.
It's supposed to be that low.
I was talking really low. Hurriedly. All right, now let's stop the sound and make sure that it's recording.
And then
So your camera is right here, your sound. And your pen is now working. You're very welcome.
so first problem you gave me was exercise 21-7, right? That's one that someone said they need to go over.
No, I have a question. That's I don't need to.
Might as well go over it now. Hour has passed. Might as well go over all three of those you gave me in this next hour. But guess what? When you come in here next week for 22,
I fixed it. Okay. I don't know. Every day I come in here and the sound isn't working, so I clicked some button over there and can't wait. That works. Is it this button? Okay. Is it this time? Okay, good. Okay. Thank you. You're welcome.
Miss Taylor, can you hear me still?
Yeah.
Somebody read that exercise to me, please. 21-7.
Students improperly reports the following information about its sales and cost of sales. Draw an estimated line of cost behavior, using a scatter diagram. And computer, I'm sorry, I got told. Fixed cost and variable cost per unit. So, then use the high-low method to estimate the fixed and variable components of the cost of sales.
So the first thing they wanted us to do was
High-low method.
do the computer fixed cost and variable cost per unit sold, right? So, okay, if you're gonna estimate fixed cost and variable cost, what is the proper thing for you to do? What is it?
You gotta find the low, low and high value.
So how are you gonna find out the variable cost per unit?
We take
You were saying it.
yeah, we take
The high and the high of cost and the low of what is the unit, right?
Yes.
So if we're looking at that, what is the highest as far as cost is concerned? Cost of sales.
900.
7,900.
because they have broken this down by period, which period are we most concerned with?
Period 10,
Why 10 and 1? Okay, so with 1, that 2,500, that is the
Initial.
and okay, so why, explain to me why you would need period 10?
period 10 has the highest cost and the highest units of production.
The reason why I asked that is because how many units were sold? How are we gonna properly estimate fixed costs? How are you gonna properly estimate what is fixed?
To find a fix, we gotta find the variable cost per unit. And then from there, we take the total cost minus the variable cost per unit.
Change in cost. Okay,
You
thank
make the
you.
whole squad down here.
Every week.
We got special shoes. They're like, how
You two, change in cost divided by change in units. My question was, you guys said that you were concerned with period 1 and period 10. Because one is the lowest and you know the other is the highest. But should you actually be concerned with that? Are you for sure?
What about 7?
Say it again, Miss Taylor. We should start with period 2.
I think.
That's why I brought it. I used the first time I used period 2
Mm-hmm.
and period 10. And when I put my answer, it says wrong. And I go up, I went back. I said, okay, let me use period 1 and period 10 and to work out. And that's why I brought the question to see if we don't have according to the book, and if you see the line they draw, you gotta use the production. Well, we do have a production.
Right. But the scattergram that you saw, those periods could have been fine. For this particular problem, you don't have a scattergram, right? Which means that you would need to probably do what?
Draw one.
Plot.
Yeah.
So maybe, just maybe, we might have to start there. Because what are we concerned about as far as when we plot, what are we looking for?
The high point and low point.
Well, you can see that just by looking at the
No, I'm
numbers.
trying to, I guess, what do you call it?
Trying to see
The
the
middle,
gap, the
I don't know,
sum.
I'm trying to find the part with the cost works.
That's minimum.
Where the language falls, the middle, I don't know how to say, I don't know how to.
I want to say it's for the slope, that's what you're
This
looking at.
problem is in the homework.
It is.
All right. When you look on page 866 in your book, like Ms. Benefield was trying to say, we're looking for the slope or line to kind of dictate where the variable cost may potentially be, right?
Right.
And before you can honestly calculate variable cost per unit, is it safe to calculate variable cost completely?
Yeah, you got to do that in order to know the topic.
Question. Because what I see when I look at this, yes, it is very visible what is the low and what is the high. However, what is your logic for just, you can't just have a logic and say, well, period 1 is low, period 10 is high. That's why I used it. Because truthfully, that's not the correct logic.
Can you go below the initial starting point, or
Can you go below? Yes. I guess what I'm trying to get you to look at, when you look at the cost of sales, right? You remember how we were going through and we were verifying what was stepwise, what was, curvilinear, things like that, right? When you look at this, what do you see? Do you see fixed, variable, mixed? What do you see? It went from 2,500 to 3,100, then from 3,100 to 3,700. Then from 3,700 to 4,300. Then from 4,300 to 4,900. That's a $600 difference, right? So out of that list, which one can you classify that as?
or the one that they hope I know? No. Curve.
So let's go into the whole high-low method. If we did high-low, you want us to do 7,900, right? And then what? Minus what?
36.
What's the lowest?
2,500.
25, right? And then the low, the units.
3,600
Uh-huh.
minus 0.
Good. All right, so that means that the cost per unit is going to be what? Yeah, because it's going to be, what is this, 5,400?
Oh, so it's gonna be 1.5?
Uh-huh, 150. 5,400 over what, 3,600? Which equals what? 1.5 or 150. So, Mr. Eva, you were doing it right. I don't know.
No, the thing is, I went back to the book,
Mm-hmm.
and when I saw they draw the line, they use the low cost and the low cost and low production unit, which one is not 0. And I went back when I use period 2 because I thought
You thought the 0 just would not matter, right?
yes.
Yeah, that's a tricky one. And I hate that they do that. That happens with this book, trying to throw, a monkey wrench in there. But I guess I should put it like this. Anytime you have a situation like that, just don't ignore the 0. Even though the book displays it as not even considering the 0. Never ignore it, because if they put it there, guess what? They want you to use it. It's stupid logic, but it happens. The next one, example exercise 21-13. 21-13. Okay. It reads, Blanchard Company Management in exercise 21-10 targets an annual after-tax income of $810,000. The company is subject to 20% income tax rate. Assume that fixed costs remain at $562,500. Compute 1, the unit sales to earn the target after-tax net income. 2, dollar sales to earn the target after-tax net income. So first thing we need to find out is what? The pre-tax? Well, unit sales at target income, but in order for you to do unit sales at target income, what would you have to do?
You gotta find the pre-tax income.
Gotta find the pre-tax income. So the equation for pre-tax income is what? What is this, 13?
Yes.
So the equation for pre-tax income, who can tell me that? Isn't it after-tax income divided by what? 1 minus what? Tax rate. So after-tax income, then what? Divided by
1 minus the tax rate.
tax rate. Okay, so if we know this now, let's plug in our numbers. What is the after-tax income if we're using information from both 2010, 2110? How much is benefit?
810.
810,000. And then what?
Divided by 1 minus 20, is it 20%?
Is that your tax rate?
The income tax rate.
20%.
Okay, so tell me what this is. And remember, going back to basic math, you know how you have to do what's in parentheses first, right?
It's 1 million.
So let's go. No, he's right. But let's do 810,000 divided by, what is that, 0.80?
Yeah.
And what is it, Mr. Ayiva?
1,012,500.
12,500.
Yes.
All right, so now that we have that, what else do we need to do? Is there anything else? Not just yet, right? So now, going back to number 1, where they want us to find the unit sales at target income. How are we going to find the unit sales at target income? What is the equation?
Fixed cost plus target pre-tax income divided by contribution margin per unit.
Okay, say it again. Fixed cost plus target
Pre-tax income
pre-tax.
divided by contribution margin per
unit. Okay, so if it's fixed cost plus pre-tax income divided by the contribution margin per unit, what do we start off with? What were your fixed costs?
fixed cost was 562,500.
Okay. And did you have target pre-tax income?
Yes.
Yeah, you just calculated that, right? Plus 1,012,500, right? And then the last thing is to divide it by what contribution margin per unit?
We go back to that.
We don't know it, right? We don't know it. So what I honestly think here is that you would have to probably go back to 21-10 and do that first in order to do this. Okay? 21-10 in your book. But the problem on your homework probably should have had a pop-up or something that gave you that info, did it not?
They give all the information.
Oh, they give everything. Okay. Okay, good. Because that was my word. All right, so we can easily go back and find the contribution margin per unit, right? What's the equation for contribution margin per unit?
Contribution margin is within divided by sales price per unit.
No, how do you find the contribution margin per unit?
Sales price per unit minus total variable cost per unit.
Sales minus variable.
Cost per unit.
So what is the sales per unit from 10?
The sales was 180.
180 minus variable cost of how much per unit?
135.
How much do we have? 45? Okay, so now we have our $45, so we can come back up to number 1, right? And divide that by 45. Somebody tell me what the amount is. How many units?
About 34,900.
So round up. 35,000
No.
to the whole?
No.
You said 34,9 something.
Yeah, 34,988.88. That's one.
We're going up because when you do units,
34,989. Yes.
when you're dealing with this type of thing, you need to go up to the whole 1,000. Whole 1,000, not whole dollar. So if it's 34,9 whatever, it needs to go up where?
So 35,000.
35,000. Simply because when you go and they should have said it in the problem.
They didn't say.
Wait a minute. 562,500 plus 1,000,000, 12,500 divided by 45. I got 35,000. So turn your rounding on your
Oh, okay.
Okay. So the second part, they're asking us to compute the dollar sales to earn the target after tax net income. Dollar sales to earn the target after tax net income. What is the dollar sales at target income equation?
Fixed cost plus pre-tax income. This time it's divided by contribution margin ratio.
Okay, so we have fixed cost plus pre-tax income divided by the contribution margin ratio, which we're gonna actually have to go back and do what?
Find the ratio.
Calculate it, right? So fixed cost plus pre-tax divided by contribution margin ratio. What's the equation for contribution margin ratio?
Sales, no, contribution margin per unit divided by
We have sales per unit minus variable cost per unit.
So I just heard two different things.
Contribution margin per unit divided by sales price per unit.
Contribution margin per unit
divided by
divided by sales per unit. So if we had to plug our numbers, we know that our contribution margin per unit was $45, right? What is our selling price? 180? So 45 divided into 180 gives us what ratio? 25%? Okay, so that 25%. Now we can come back here. What was our fixed cost?
562,500.
Pre-tax income was 1,012,500 divided by 25%. which equals what?
6,000. I mean 6,000,000.
6.3 million. 6,300,000. Good. Okay. The next one you had was problem 21-4A. That's the one you need help on?
Oh, my God. Okay. I don't give a.
Problem 21-4A. Is it long?
No, it's just asking them which one is fixed, variable, mixed, stepwise.
And I did say, maybe I thought right, but it's not saying it's wrong.
You said 21-4 exercise.
Problem. Problem 21-4A. Okay, so we got 5 different parts. Astro Company sold 20,000 units of its only product and incurred a $50,000 loss, ignoring taxes, for the current year, as shown here. During a planning session for 2014's activities, the product manager notes that variable costs can be reduced 50% by installing a machine that automates several operations. To obtain these savings, the company must increase its annual fixed cost by $200,000. The maximum output capacity of the company is 40,000 units per year. First thing that they want us to do is compute the break-even point in dollar sales for 2013. Now, what is the equation for computing break-even in dollar sales? Fixed costs divided by what?
Contribution margin ratio.
Is that it? Okay, so did they give you the contribution margin ratio? Nope, we have to calculate it. So we've done this just now recently, right? In order for us to get the contribution margin ratio, we're going to have to calculate what? Contribution margin per unit. Now, contribution margin per unit is selling minus variable per unit minus variable selling price, right? What's the selling per unit? How much, Miss Taylor? 1 million. And divided by what? 800,000. Everybody agrees? Is it just 1 million straight, right? Minus 800,000 gives us what? 200,000. That's just the contribution margin per what?
It's not for you.
What cost are you guys giving me?
No, but that is, it's not for you.
That's what I'm asking. I asked what was the selling price per unit.
It has to be divided by number of units.
So you don't even have that.
No, that's what I'm getting.
So in order for you to find it per unit, you just need to take the sales amount and divide it by the amount of units that were sold.
Well, they said it's $50,000 loss.
We can directly go
That has-
divide contribution margin by number of units. You will get contribution margin.
Yeah.
Let's go the long way though. Sales, first of all, the first thing you need to do is calculate what?
Sales per unit.
Sales per unit
Yeah.
by taking the amount of sales, which was what, 1 million? and divide that into what?
20,000.
20,000 units, which gives us what?
Divided by 20,000.
$50. Now this is what?
That's the
Sales price by the unit.
Sales price
Sales price.
per unit. Now we need to find contribution margin per unit.
No, we still have to find the variable cost per unit.
Y'all don't have that either?
No, they go put it in the unit.
Variable cost per unit. What's the equation?
Total variable cost by number of units.
Total variable divided by
Number of units.
units sold. What's the variable, total variable cost?
800,000.
800,000 divided by 20,000, which gives us, can we now go to contribution margin per unit? All right, contribution margin per unit.
Selling price per unit.
Selling price, thank you. Selling price minus variable.
Cost per unit.
Selling price was what, 1 million? I mean, I'm sorry,
50.
$10. Now to get the ratio. Contribution margin per unit divided by selling price, which is what percent? 20%. All right. All right. Going back to part 1, what are the fixed costs?
250,000.
250,000. And we need to divide that by what?
20%.
20%, which is the contribution margin ratio, which gives us what? $1,200,000. 250,000. Okay, good. Now, part 2. Compute the predicted break-even point in dollar sales of for year 2014, assuming the machine is installed and there is no change in the unit sales price. That's a lot more computing. How do we get how are we going to compute the predicted fixed cost? This is part 1. How do you get the predicted fixed cost?
Is that the margin of safety?
Not margin of safety, but what were your costs in 2013?
It was, unit sales, that's sales per unit, right?
In the book they give, they say the costs are increased
Uh-huh,
by 200,000
uh-huh.
and also they give us the unit, no change on the unit sales price. We can go from there and then
$50
they said
times what?
50% because they have increase of
What I'm asking is what are 2013 fixed costs? That's what I'm asking.
Fixed cost is $250,000.
Okay. So that's what we're trying to get to. The new or the fixed cost amount is gonna be 2013's fixed cost plus what?
200,000.
Since that, which is what? 2014. Since there was no predicted, no change, we take what was existing
Okay, 250,000.
plus 200,000 gives us fixed cost of what?
450,000.
450,000. And
Okay.
they want us to do the break-even point in dollar sales, right? What is it gonna take for us to do that? How do you get break-even in dollar sales?
Fixed cost divided by
Fixed cost divided by contribution margin ratio, which we have, right?
Yes.
What?
20%.
What's your fixed cost though?
250. 250,000.
No, it's not. We just went over it.
You're supposed to answer.
450.
450,000. And what about your contribution margin ratio?
20%.
It's not 20% anymore. What has happened?
The variable cost is
Variable cost has changed, right?
Yes.
So if the variable costs have changed, not 400, what were the variable costs before? $40. And how much did they say they went up?
The price goes down, reduced by 50%.
Oh, went down.
Yeah.
So what? That's 20 bucks.
Yes.
Okay, so
Right now,
since the variable costs have went down, and I'll just write it up here so no one is confused. The variable cost before was what? 40%?
yes, $40.
$40 times 50%, which that 50% was a reduction, which equals a $20 difference. Now at this point, with that $20 difference, we're going to do what? Take our selling price
Yes.
and subtract what?
Variable cost,
Which is
20. It's going to be 50 minus 20.
the new variable cost of $20. So 50 minus $20 is 30, right?
Yes.
And then what else do you need to do to get the contribution margin ratio?
Find out the 30 divided by 50.
Why 50? That's the contribution margin equation, right?
Yes.
So then we do 30 divided by 50, which gives us what?
60%.
60%. This is now what comes here, right? Which gives us what? What's the amount? 450,000 divided by 60%.
750,000.
750,000 is the break even in sales dollars, right? Now, part 3 says, prepare a forecasted contribution margin income statement for 2014 that shows the expected results with the machine installed. Assume that the unit sales price and the number of units sold will not change and no income taxes will be due. So do you guys have an example in front of you of what a contribution margin income statement looks like? I'll take that as a no.
Contribution margin income statement, right?
Huh?
What you just said?
Contribution margin income statement.
We have sales.
What he said is good.
I just asked if you had in front of you an example of what it looks like.
Yes.
Yes, you do.
Question, the mind, the wheels are spinning. Okay, so what do I start off with?
Sales.
Sales. And what amount were sales? How many units did you sell?
20,000.
And what's your price per unit? $50. So 20,000 units times $50 is how much? 1 million. What's next?
Variable costs.
Variable cost. How much?
We sold
20,000 times what?
30, 40.
20. That was the new amount, remember? How much is that?
400,000.
What's next?
We have contribution margin.
And that just verifies what you have been doing this whole time, right? What's your contribution margin?
600,000.
What's next?
Costs.
Fixed costs. And what were they?
450,000.
What's next?
And the next block out means.
Gonna be net income, right?
Net income?
Yes.
Because it's positive, right?
Uh-huh.
How much is the amount?
150.
Good. Part 4. Once you start, you must finish. Yes. Okay, part 4 says compute the sales level required in both dollars and units to earn 140,000 of after-tax income in 2014 with the machine installed and no change in the unit sales price. Assume that the income tax rate is 30%. Use the procedures in Exhibit 21.22 and 21.23. Round answers to whole dollars or units. So we got a couple of things going on. First, we need to find out what are the required sales in dollars. What's the equation for that?
Divided by contribution margin.
Fixed cost plus what?
Pre-tax income.
So we got fixed cost plus target income plus what else? Or what else?
Marginal ratio. Contribution marginal ratio.
All right. These are just using numbers we already have, correct? Yeah. What's the amounts here? So we just plug in. What were the fixed costs? 450,000. What was the target income?
Right, we're gonna find out the new target income because they give us after
You already know what I know you know what it is? Because what were the
I don't know, because right here they say assume that the income tax rate is 30%.
Oh, maybe it's 200,000.
oh, I'm sorry, I said it wrong. I said target income, but it's target pre-tax income, right?
Yes.
So the given was how much? What was the target income amount that they gave you?
They give us tax income, which one is
That's 140.
140.
And what else should you do to this 140?
You gotta divide by 1 minus the rate.
One minus the
tax,
rate,
tax rate.
tax rate. What's the tax rate?
30%.
0.30. What do you get? 140 divided by what?
0.7.
And then after that, what is your new income? Target income. 200,000. So plus 200,000 here, divided by what ratio? Or I'm sorry, contribution margin ratio.
It's gonna be 60%.
60%, right? You remember that from the previous? So 60%, and then the best thing to do is 450,000 plus 200,000, 650,000 divided by 60%, which equals what?
It's 1 million.
Say it again, Ms. Dallas.
1,083,333.
The previous part. And that is required sales in dollars. Now, how do we find required sales in units?
We take fixed cost plus target income divided by contribution margin.
So fixed cost plus
Target income.
target pre-tax income divided by contribution margin per unit.
Yes.
Contribution margin per unit. And in this case, what are the fixed costs?
You gotta say how much? 450
450,000
plus 2.
plus 200,000. Yes. Divided by
30. Because our sale price is 50, and then the variable cost is
50 minus 20.
20.
Just using the information from the last problem. But this is basically 650,000 divided by the 30, which gives us what in units?
21,667.
21,667 units. Okay, part 5. No, it just keeps on giving. Prepare a forecasted contribution margin income statement that shows the result at the sales level computed in part 4. Assume an income tax rate of 30%. All right. So what comes first? Sales. How many units? 21,667 times what price? Gives us how much in sales? So 1,083,350 variable costs. How much? Same 21,667 units times what price? $20. What amount? $433,340. Contribution margin. How much is it? Basically, if you subtract the 20 from the 50, 21,667 times 30. How much is it?
It's gonna be 650,010.
$650,010.
Yes.
And what comes next?
Fixed cost.
Fixed cost. Which were how much?
450.
450,000. Which means pre-tax is how much? Or before tax income is how much?
200,010.
200,010. And then at that point, what has changed about this particular statement?
We add the pre-tax income and
You got to calculate the income tax, right?
yes,
What did they say the income tax rate was?
30%.
30%. So what are you going to take and multiply it by 30%? 200,010, right? 200,010 times 30%, which gives us how much for income taxes?
60,000.
You said it's $60,000. And so now our net income or net loss, which one is it? Income? How much?
Yeah, 140,000.
140. Whew. Bruh. One forever. Okay, so next week, chapter what?
22.
22, right?
Thank you so very much.
You gotta thank the tech support.